Hello, good afternoon, and welcome to our third webinar and final webinar from the Power of Energy Efficiency webinar series. My name is Caroline Milne. I hosted the last webinar, so I'm sure that you are probably familiar with my voice by now. I will be speaking today with a colleague and with a friend and colleague named Alistair Brown from Lumenstream. So this webinar today will be a little bit different from the past webinars that we've done. I'll give a little bit of an introduction again to the series for those who are new, and then I'll be following up with a discussion, a short discussion with Alistair himself. So he's the managing director of Lumenstream, Belfast-based ESCO, and we actually went over his case study, his story a little bit for the previous webinar on energy performance contracting. And before we discuss available finance today, I think it's really interesting to actually hear the first-hand experience of an ESCO who has been dealing with finance, third-party finance, over the past year and who is continuing to deal with it. So really thank you, Alistair, for joining, and really looking forward to speaking with you on that. So today, the purpose of this webinar is to look at what finance is available today, what investor requirements are for energy efficiency and demand-side projects in Europe, particularly in Ireland and in the UK. I know we have a very strong audience from Ireland as well as the UK. Thanks very much in part to the sponsorship and promotion from the Irish Green Building Council as well as the UK Green Building Council. And so before I get into the presentation, my own presentation, I would just like to hand the floor over to Marion Jamet, of the Business Development Director of the Irish Green Building Council, just to say a few words.
Thank you, Caroline, and thank you, Julia Set, for organizing this webinar today and this webinar series, I suppose, Power of Energy Efficiency. For those of you who don't know us, the Irish Green Building Council is a membership organization. We have close to 140 members at the moment from the broad construction sector. And what we do, I suppose, we do a lot of advocacy and education as well, with many training and indeed conferences and webinar series like today. If you are not familiar with us, I suppose we are a member of the World Green Building Council, so you may be familiar with another Green Building Council in your country. So you may be a member of the UK Green Building Council, for instance. But as part of our education program, what I found interesting is that last week we had a big conference in Dublin, the Green Room, and there were kind of a few key findings, I suppose, on the day. Obviously, it's clear that we need to act fast. There is a sense of emergency to move toward carbon neutral buildings. And we also had kind of lots of interesting case study, I suppose, from a technical point of view, with the managing director of Snetta in Norway and the porous concept. So basically the idea of a building that can actually produce more renewable energies and it actually use through its whole life cycle. So it was interesting to see this sense of emergency and this kind of very inspiring, I suppose, case studies, but at the same time, when we had the panel discussion with Irish architects and engineers, lots of them still mentioning that often, I suppose, finance is the issue, and how do you finance this type of very inspiring project, and even more like, how do you actually finance energy efficiency? So I'm really pleased, I suppose, that Julia Set has organized this whole series of webinars, and to look today at, I mean, that's the third webinar, but I'm really interested today in looking at even more financing option, but also, I suppose, to look at investor requirement. I think it's really critical for people in the industry, like in the building industry, in the green industry, to get a better understanding of investors' requirement and to better understand, I suppose, or we can talk with investor and their vocabulary, and so that's why I'm really pleased to that Julia said organizing this webinar today. And I know Caroline has mentioned there are quite a few people on the webinar today based in Ireland. So if you want to continue the conversation, I just would like to mention that Caroline will actually be in Dublin with us on the 29th of May for a follow-up event. So if you want more information, everything is on our website. It's igbc.ie, and that's really it for me now. And thanks, Caroline.
Thank you, Marion, very much. And I think I'm going to give a quick introduction again. Many of you have probably seen this slide, which I used last time, so I'll go through this quickly. But I think that you really hit a few of the key messages, again, that this series is really about and why we're doing this. So I mentioned in the last webinar series, why did we do this? Because energy efficiency is one of the most powerful tools at our disposal to combat climate change now, and because the finance is there. It's not perfect. The finance world, from what we've seen as dual assets over the past few years, is not 100% fit to purpose for the energy efficiency industry, but it's getting there. And the aim of this series is really to do what we can with what we have, where we are right now, while we also continue to look to improve the market and build and create more solutions and continue to bridge that gap. I'll give a little bit of an introduction on Joule, which I don't think I did so much in the previous webinars. So for those of you who don't know us, we launched actually as an investment fund for small energy efficiency and demand side projects in New York in 2010. And we really developed their very strong knowledge in both financing models, performance-based financing models, and also on the actual engineering side. We got to know very well the ESCO business models, how they work, what the technologies really are, and then how those projects and the finance can actually meet. And so the story is that our CEO in New York, Mike Gordon at the time, wanted to, he was considering developing a pipeline of projects to finance in Europe as well. And he looked to get he got a small team together to, start exploring the market here. And we quickly realized that, in fact, there was already quite a lot of money. And building a fund is a lot of work. It's very time consuming. It's also a huge upfront investment. And it didn't really make sense, especially with the fact that there was so much potential already. The problem that we understood in speaking to many investment funds early on was that the finance guys were having a hard time actually meeting the projects and vice versa. There was really an issue with language between the two. There was an issue that contractors had in, and when I say contractors, I use this term broadly, so it could be an engineering company, an energy service company, generally project developers of energy efficiency renewables projects. They were having a very hard time presenting their projects to finance and also even knowing what finance was available. Often bank debt was looked at as the first and natural solution to financing a project. And so with that in mind, we were a bit, we were scrappy, and we won a proposal for an EU-funded project under H2020 called SEAF, the Sustainable Energy Assets Framework. And this project went from 2016 to May 2018, where we took a lot of our knowledge and learnings already from our work in the US as a fund and brought it to Europe in the form of an online platform, which we now use and operate, called eQuad. And eQuad is essentially what it does financial modeling of projects. It will create a pro forma of a project that it'll take an energy efficiency or demand side project and transform it into investor language and make it very simple and easy for them to understand, and make it simple and easy for them to know whether they want to invest, whether it fits their criteria right off the bat. The platform has other functionalities as well, which I'm happy to answer questions on after. The idea is really to standardize the the project as much as possible and really close that gap between the project and the finance, and to make sure that both get the best deal. Also now in New York, just as an aside, our team is still humming along, but we no longer have a fund. We've actually since launched an ESCO called Joule Smart, and more importantly, which is something that I'm working on more closely now, we've also launched a business unit called Joule Community Power, where we're really leading the way in New York State towards community-based energy. So it's all very exciting to see these kind of developments and see the small projects and communities and really energy efficiency start to break into the most local grassroots level, and that ultimately that vision is what drives our everyday work. And while it looks a little bit disjointed, I'm just going to say it out loud, it might look a little bit disjointed to have the community power in the US and EQuad in Europe, but what we do have and benefit from is a very strong team on both sides of the Atlantic, where we share our knowledge on a regular basis and are supporting one another, and most importantly just have this vision of a more local energy system which empowers the smaller players and which makes sure that the smallest projects are getting financed. And you really need support and determination for that. And yeah, we need it every day, and it drives us every day. So again, just coming back to EQuad, the numbers back it up as well. It's not just a feeling. So the European Commission estimates that we need 177 billion euros from public and private investment to reach our 2030 climate goals. More than that, I had the good fortune of being at the IGBC event in Dublin last Wednesday, and then I was actually at the International Energy Research Centre's annual conference in Cork on Thursday. So I was very moved by the energy in both of the rooms and hearing from different players in the market, from architects to engineers to building owners to other tech startups. And the message, what I found was missing, there weren't a lot of finance experts in the room. In fact, we were the only one. And what I found really was missing from the discussion was the finance. And I think that's where we sit as Joule Assets. That's our role, is to assist and facilitate on the finance side. I would say that the common theme that I heard during those two events was collaboration. Many people repeated the need for this new energy paradigm that we're all looking to create. We need to create it together. That means at the very beginning of a project, someone used the example at the Green Room event, having the architect, having the engineer, having the building owner all in the room at the same time, developing the project together. And I think as Joule, we would also go so far as to say that the finance player needs to be in the room from the beginning. And I think you'll hear from Alistair in just a moment, because financiers are everyone is new to this transition, but financiers as well have a huge learning curve. And we've experienced that firsthand and are looking to support them in their journey towards investing in these types of projects in a more scalable way. But indeed, they need to be included in the conversation as early as possible so they too can adjust and improve their own processes. So with that in mind, before I get into talking about the financing that is actually available right now, I would like to ask Alistair to join me. And just if you could introduce yourself a little bit and explain about what Lumenstream does, who you are, and basically why you were looking for third-party financing from the outset.
Sure thing. Hi everybody. My name is Alistair Brown. I'm the managing director of Lumenstream. Again, thanks for the kind introduction earlier on there, Caroline. But basically, back in about 2013, my colleagues and I had opened a business focused on supplying LED lighting and upgrading businesses to LED lighting via the traditional quotation, payback, and invoicing method. Now, that has been very successful, but we found out a few different things along the way. One of those was that using a mixture of energy efficiency grants, such as zero interest loans, combined with other grants from, say, regional utility suppliers, was the only way that clients would be willing to switch to LED lighting, due to the fact that the upgrade costs were too high. What we also found was that in many cases, this combination of grants and subsequent, often complicated application processes was too much of a headache for clients, and so they would lose interest along the way. Um, Further to that, we found there was a lot of competition to our business in a very noisy marketplace with lots of misleading information on energy savings being provided to potential customers, which created a level of distrust towards the industry that we were in. So, for that mixed bag of reasons, we wanted to achieve three things. Firstly, to develop a business model that would be pay as you save for our clients. Secondly, we thought it would be best if there was some way that we could consolidate any capital requirements so that they would be coming from one source for simplicity purposes from the client's perspective. And thirdly, provide an unambiguous approach to our proposals using conservative figures within our energy savings projections, which should hopefully guarantee customer satisfaction at the end of the day. So based on these reasons, we set up the company Lumenstream in order to achieve this. So today, Lumenstream are an ESCO, and we specialize in LED lighting, and we offer our clients the LED lighting as a service or pay-as-you-save approach to selling and upgrading businesses to energy efficiency.
Thank you, Alistair. And can I just ask you a little bit now to talk about more about your experience with financing? So why did you look then for equity as opposed to debt? Because I know that's what we ended up going for. Why was that the best solution for you? And what were some of the pros and cons? Because I know equity isn't necessarily easy to deal with either.
Yeah, the equity fund, we went towards equity because we felt that the equity fund enabled us to pitch a project to our equity investor. We could then agree on an IRR and payment terms to complete the project. And then it kind of gave us flexibility to move on to the next project or client. We found that going through the equity route provided us with financial mobility to offer our service to many clients without, for example, having to go to the bank and take out a large loan in order to do that.
Yeah, I that makes sense, and that's what I would imagine that would be the case for for most businesses who are looking to achieve the same sort of business model. So in general, with your experience having dealt with an equity financier up until now, can you tell us a little bit about your experience of some of the positives and some of the negatives that you've had? And has it been worth it up until now? Because I know it hasn't been just a walk in the park either.
Yeah, I would say overall, yes, it's been worth it because as a business, at this point, we are doing exactly what we set out to achieve a couple of years ago when we started going down this path. At the same time, going back to what you were saying in your introduction, we as an ESCO are still on a journey and we're learning as we go. And working with the investment group that we're working with, we're kind of ironing out a lot of problems as we go, during that journey. I think the pros that you get if you go via the route of a third-party financier is that if you get a third-party financier that understands exactly what your business is trying to achieve and then gets on board with that, then it can work very well. A con would be for me that it can be difficult to find a fund that maybe completely aligns with what you're seeking to offer your clients. So, my advice really would be to anybody trying to set up this kind of business would to be very careful with how, say, regulatory requirements on the third-party fund could have an impact on, how and what you're trying to sell to your clients as an energy savings package.
Thank you very much. And I think those are some very well raised points. I forgot to mention to the audience that we will be doing Q&A at the very end. There is a questions box in your GoToWebinar control panel, so please feel free to type in your questions as they come, and we'll take them at the end. And same goes for if you have any questions for Alistair, feel free to type them in there, and we'll get to those in due time. Alistair, thank you very much actually for going through that. I think we talk about this a lot in theory, but it's very good to actually hear from someone who's been through the process of setting up this business model and dealing with the finance and the customers all at the same time. And I know that I think that you've had tremendous success thus far getting a pipeline together and really putting it out there successfully. And I'm just really impressed because I know it takes a lot of willpower, and it's nice to have someone who's actually doing the work on the ground, doing the really small projects as well that not many others are actually going for. That's not easy, and I think that this is really the way of the future. And there has to be, I think that you're one of the first ones, especially in your market. So I applaud you. And
thank you very much.
I will, of course, yeah, of course, thank you. So please do stay on for questions. I'm going to get in now to the part of the finance part that that Marion was very much looking forward to hearing about. So I'm going to be presenting some financing options that we have within our eQuad investor network that are available now for small energy efficiency and renewable generation projects, particularly in Ireland and the UK. So if a contractor is looking for a different form of finance from traditional bank loans, for example, these are the main options that we have found available right now. They're particularly interesting for those contractors who want to diversify their financing sources and have their projects or a part of their pipeline off balance sheet. So not meaning you don't have to go for a loan every single time and take it on as debt. As you'll see in the following slides, all these structures involve the creation of an SPV, a special purpose vehicle that takes on the finance burden instead of the contractor. So it's basically, I'm sure most of you are familiar with this structure. It can be done in different ways, but essentially, rather than take on the debt or take the finance on yourself as a business, it would be like a separate company is set up that's dedicated to your project pipeline, and there would be a ownership structure between the contractor, the investor, the project owner, or some form like that. So we have here bridge finance, full equity, and ethical banking, and factoring, also known as sale of receivables. So for each one, I'll just give you a very brief description and show you what kind of projects, clients, and contractual structures fit these financing structures the best. And if you're interested in learning more about them also, or you have projects that you're looking for funding for now, you can also feel free to send me an email after, and we can have an individual call to explore the best options if this is of interest. So starting with bridge finance. In this case, we have an investor who offers around 70 to 80% of the financing in the form of debt, who has two fundamental requirements. Number one, that the ESCO has to participate in the investment, so the ESCO would have to offer about 20 to 40% of the total investment themselves. And then that there is a financial institution, which can also be a bank, or it could be another investor as well, that's willing to buy the project after 2 or 3 years. So taking a closer look, as you can see from this this graphic here, we have the ESCO that is responsible for the installation, operation, maintenance, and measurement and verification, and also for the creation of an SPV. So the ESCO takes on a very large responsibility here. The ESCO is also the one that signs the contract. Oh, That wasn't expected. The ESCO is also the one that signs the contract with the end customer or building owner, which this can be EPC or other options, which we'll look at in the next slide. The contract, however, in this case is signed by the customer and the SPV. So it's not the ESCO who signs the contract for the project. It would be the entire special purpose vehicle. As you can see here on the right, the ESCO's balance sheet is completely free, and that's because the whole project stays on the balance sheet of the SPV. And as I mentioned earlier, it's important to highlight that in all these options, there's always an SPV involved, and that the project therefore falls on its balance sheet. It's not on the ESCO's balance sheet, which is why these alternative financing structures are especially interesting for growing ESCOs as compared to standard bank loan. In some cases, specifically this one, bridge financing, as well as the ethical bank, which we'll look at shortly, the ESCO can, or they sometimes have to, participate in the SPV. In other cases, the investor is the only owner. So it depends. This depends on a few different factors, which is really taken more case by case. But looking at bridge financing, its main difference from the other options that we'll see is that this isn't a long-term stable loan. It's bridge capital, really to get you over the initial hump. It covers the construction phase of the project. So what does that mean? It means that the investor will exit the project after a period of, a number of years. It's usually anywhere from 6 to 36 months, so half a year to 3 years. And this depends on the timeline of the project, obviously. So after this period, another investor then takes over and purchases the part that the first investor had as well. So the whole investment that the first investor made. At the top right, you see the cost of money, the interest. As you can see, the bridge investor is quite expensive. So it starts at about 7%. But at the same time, it assumes all the construction costs, risk of the project, which is quite interesting. This means that the new investor who takes over will do so with much lower interest rates than usual, because obviously there is less risk around the implementation of the project. So for example, maybe 3 or 4%. So the self-financing, as I said, in this case is mandatory, and it's in a range between 20 and 40%. There's flexibility anyway, so in some cases it can also be the final customer if it's agreed between the parties. I would say that in general, this type of finance would be quite interesting for, not exclusively, but definitely for one single larger project that would be, and when I say large, I don't even mean like 20 million, I mean like 3-4 million or even 2 million. But very often, at least at Joule, we see pipelines of very small projects, well under $1 million, 50 to 100,000 each. So if you're looking at one whole project that's say 2 to 4 million, more or less, give or take a few, it's quite interesting for this because it's a big chunk of investment, let's say, and I'll just move on to the next slide. So what's different, I would say, between bridge capital, first of all, and classic debt? So it's that the financing lasts only for a short period of time, and it's always in the perspective of selling it to another entity. The benefits, as I mentioned, its interest rate after 2 years becomes very low because there's no longer any risk of installation and performance, etc. So for this, you might ask, why not directly go to the bank? Because in general, the bank isn't usually willing to take the initial risk. And that's why I would say as well, for a larger project, it's especially interesting. A bank might not be able to do that, especially for such a sum. So it's easier for them to commit later on when the project is already up and running and it demonstrates that it's bringing the expected savings. So here we have the investment criteria for bridge finance. The technologies allowed, as you can see, anything that falls under proven energy efficiency upgrades, public lighting, district heating, cogeneration, and PV. As a reminder, for large renewables, there's no funding available in our network because it's not in our interest in general. The market is already structured, and we really don't need EQuad to cover that. So if you're looking at a very large PV plant or PV field or wind field, for example, it's better to go directly to investors. There's a lot of available investment for large renewables projects. It's really the small ones, and especially the small ones that might be combining energy efficiency along with renewables integrated into the project, where it's harder to find the finance initially. Government incentives are recognized for this, so in the sense that the investor considers them within the business plan and therefore as revenues of the project. Not all investors do this, especially not in all European states. So there are countries where the stability of government incentives isn't great, and therefore investors perceive them as a risk more than anything else. So it really depends on the market that we're in. But in theory, if it's a strong market, if it's more stable, then the incentive would be recognized. The end client can be all sectors, so public, private, industrial, commercial, for example. And the contract structures are also very flexible. This can be operating lease, EPC, or PPA. And additionally, the one additional thing here, which is different from the other forms, is that the investor requires a letter of intent from another investor to refinance after the 2 or 3 years. You might find a different investor, but they at least need to know that there's other investor interest. So there is a bit of, there's some reasonable amount of homework to do. However, I would also say that within our own network, we have other investors who could also provide letters of intent for the second part of the project. So it's not always as challenging to get these pieces in order as it might seem at the outset. The next opportunity is full equity. Here, the investor creates the vehicle company and provides 100% of the equity of the project. The ESCO here maintains a more marginal role, more as an installer, so it's not part of the SPV and therefore it doesn't receive the project cash flows. So why would you choose full equity in this case? Well, first of all, it depends on the contractual structure. If it's an EPC with guaranteed savings, for example, the ESCO has the financing all off balance sheet, and in addition, it receives all the excess performance of the project. This is if it's EPC. If there are other options with less risk, the investor has, in this case, an interest in having a very simple contract, such as an operational lease. However, that depends also on the technology that's used. For example, operational leasing is the classic approach for rooftop PVs, where panels are a guarantee and paybacks are very, very simple. In any case, it's a good way to diversify the pipeline financing strategy of an ESCO and lighten the balance sheet if it is a bit already burdened, if you've had enough debt. It's important to have a well-structured sales business strategy here, sales-oriented business strategy, I'd say, because the customer has to be happy with the financing structure. Of course, all the financial benefits here would go to the investor, but the customers would still benefit from the savings on the bill and the building efficiency and all the added value, the added comfort that it brings, etc. It just needs, I would say, more sensitive sales message. At the top right over here, you'll see the cost of money, the interest is sorry, one. Oh, sorry, there. Apologies, I just had difficulty switching slides. Okay, so looking at full equity requirements here, it's the same technologies as the previous, as the bridge financing, so energy efficiency upgrades, public lighting, cogeneration, and PV. The project sizes are really looking at a minimum of 100,000 euros per project, with a minimum pipeline of 100,000 euros. The maximum project size would be 3 million here. Again, all sectors are allowed as well, but the end client cannot be like a micro enterprise. So it has to have more than 10 million euros annual turnover, and their balance sheet can't exceed 3 times the net debt. So in other words, what this means is that it's very important to check the final customer's financial health, because the investor must have the certainty that they're able to pay for the whole duration of the project. PPAs are also accepted here, as well as operational lease, energy service contracts. So these are, EPCs can also work in the case of guaranteed savings. And again, government incentives are recognized, and it's the same as bridge financing. In general, it has to come from a more stable market. If the market might be changing or regulation is changing constantly, then these would be seen as a risk. The next opportunity we're looking at is an ethical bank. So this is a form of debt, but for ESCOs, it's actually structured as off-balance sheet again for the ESCO, so as an SPV once again. It's different from the other forms, so as, for example, factoring, which we'll look at in a moment, or full equity, in that it offers a cheaper cost of capital, but at the same time it asks at least for some buy-in from the ESCO or from the end client. So the bank would provide about 60 to 80% of the finance, while the ESCO then provides the rest. And the required return here is quite interesting. It's just around 2%, so it's quite low. Here we can just see the full equity requirements. So again, same technologies as before. The minimum pipeline size would have to be 2.5 million euros, and the maximum project size 15 million euros. So you can have one very, very large project and just do an SPV for this one project, or you can come with a pipeline of smaller projects. The pipeline just has to be 2.5 million or above. And I don't believe that there is a minimum for the project size itself within the pipeline, as long as the pipeline hits 2.5 million. Government incentives are again recognized, which is definitely good news. There are some restrictions as well to the type of the end client. So it's only tertiary, residential, and public administration. And they also have to comply with specific environmental, social, and governance criteria defined from bank to bank. And again, contracts are quite open. So operational lease, energy service contracts, EPC. The last opportunity that we're going to look at is factoring. This is also known as sale of receivables. So here, the investor provides the finance for the entire project and creates the SPV. The difference from full equity is that the yields are lower, but on the other hand, the investment criteria is more restrictive and quite firm. So if this works, it could be a very, very good solution. It's just difficult to make sure that it works, essentially. So in principle, factoring is quite simple. The ESCO installs, manages, and monitors the project, while the investor basically buys the project or pays the ESCO for the total investment, and in return buys all the future receivables of the project. You can think of receivables as like future invoices almost, or energy bills. So it's like they're paying for the energy bills or in advance. In this case, it differs from classical equity because it's a more formal and structured way to secure future cash flows. The project is always off balance sheet for the ESCO. It's paid in a first initial tranche for the construction, and then future receivables are purchased. For the ESCO, there's the possibility of having off balance sheet projects, replicable and easy to implement. Factoring can be used straight away, so example, even before the start of the project, but can also be used to resell projects that you want to remove from your balance sheet. So this can be interesting to transform assets into liquidity and enlarge your pipeline, and then keep building and growing as time goes on. So again, the criteria of investors for the sale of receivables here, technology is the same. There's nothing to add from the previous slides, except we did building management and behind the meter as well. Project pipeline, the minimum project size again is 100,000. The minimum pipeline size is 2 million. So this might be discouraging for some, or it can be challenging. You do need to have at least 2 million of pipeline of small projects of 100K or above. Another thing is, unlike the other ones, government incentives are not recognized. All clients types are welcome. So from public administration, industry, tertiary sector, anything essentially goes. Again, as I mentioned, I think in previous webinars and earlier, the quality of the end client, the credit worthiness of the end client is always a factor. So this has to be one of the very first things that you would check as an ESCO when you're looking to sell to them, actually. And then finally, contract types, again, energy service contracts, EPC, PPA. So that's basically what's covered. So I would just say to finish up that if you are interested, what we've done is we've actually started a very short like 5-minute survey. You can find this directly if you go onto our website. It's eu.joulassets.com, or you can just click on the link in the slides, which we'll send to you after the webinar, or you can just contact us directly and we can send you the link ourselves. It's about, it takes 5 minutes, and it's not a very thorough, detailed assessment, but it basically gives a very good indication for us what types of finance could fit the types of projects that you have, so that if you're interested in going down that route and basically vetting your pipeline and doing all the financial valuation for the projects, then we know that we wouldn't be wasting each other's time, that we could work together and actually make something happen, hopefully quicker than it would have happened otherwise. That's the whole purpose of what we're doing. And we will, yes, be speaking again in Dublin, as Marion mentioned, on the 29th of May. So if you check their website, we'd love to meet you there if you happen to be in Dublin. And just to close, I would say that as I mentioned in the webinar on EPC previously, and I've mentioned that this briefly as well starting off today, the finance world isn't 100% fit to purpose for the energy efficiency world. As you could see from the funds, the types of finance that I mentioned, each form of financing and each fund in general has their own specificities, which can be great, but it also means that they each have different ways of working. So we're looking very much to standardize this process a little bit more. And also we have a project coming up, which I'm not going to tell you about now, but I'm very excited about, and I'll be speaking about this in May, on essentially how we are further looking to enable much greater scalability for the finance sector as well as for the project sector. The reality of the market is that projects are small, and we need to build tools that will enable large-scale aggregation of projects for finance as well. And that's really our mission. We're not 100% there yet. So what we see with eQuad is that, as I mentioned before, we're doing what we can, what we have, where we are. There's no time to waste. I don't want to sound cheesy, but climate change is very, very urgent, and we need to meet our 2030 targets. And for us, we consider that every project that we can get finance for and get off the ground, the better. So we're doing the two at once, looking to finance projects now with the finance available, and continue to work to bring the tools to the market that will help speed up the whole process. I believe I have some questions. So I'm just going to take a couple moments now to looking at some of these. And if I don't get to all of them right now, then I will also follow up with you personally over email. One question I have, this is very common, is what is the cost of finance? So the interests, so like the interest that investors are charging. This is what we would define as required return in the slides that you saw that were at the very top right. So for example, in bridge finance, the interest rate is about 7%. The investor takes 1 million and then after 2 years receives about 1 million back from the bank. In the meantime, the bridge investor has received 2 annual payments around, say, 65,000. That would be to reach an IRR of 7% after 2 years. So in this case, the costs of finance for the project is around 7%. And again, I understand that if you compare that to a bank loan, it seems very high. A bank loan you might have at 2 or 3%. But again, when it comes to projects that might be, say, a bit larger, a few million, a bank might not be willing to take on the risk, especially the construction and the performance risk. And so what's interesting is the 7% is high in the beginning, but then your interest rate will go right down quite low for the remainder of the project. And especially if you're trying to juggle your end client, the owner of the project, and convince them that this project can go ahead and you can take on the finance. The bridge financing is quite interesting. I know that there is a very strong appetite in this area, at least for projects that might be more ambitious. For example, a project with multiple sites. That's definitely something that an investor could secure a deal with very, very quickly, and it, yeah, it's a great way to secure the sale with the end client. So I'm just going through some of these questions now. How does it get over the issue of balance sheet? I think I have a question actually for Alistair. This is an open question. How would you get over, Alistair, as an ESCO, the issue of your balance sheet clogging up with contracts while you're onboarding initially?
The kind of arrangement that we have, there isn't really much of a balance sheet impact on our business, the kind of finance option that we have with our investor. So we have an SPV arrangement there that effectively takes on the burden of that. We then have an arrangement with our financier of how we get paid once the project's complete, whether that's over the tracks as like a co-investment, or whether it's a one-off payment, at an early stage, for example, shortly after the project's been completed.
Okay. I think I won't try to answer that question as well, because I think that you have more experience in this domain than I do. I have another question. Is it possible to have a shared savings EPC in full equity? So I'm thinking, I think the answer would be no, based on, I'm thinking of the investors, at least that we are working with here, because the contract is signed between the investor and the end customer, and then the ESCO has an external role. So the investor would tend to prefer simpler contractual structures here, since he takes on all the risks. I'll just have I don't want to take too much more time, so I'll go through about 2 more questions. So I apologize, I don't have another hostess today, so it's just me reading the questions as well. So what's the difference between an ethical bank and a normal bank? That's a good question. The ethical option is different from other banks because it's more familiar with these types of projects already. They would be a bit more advanced. They've had energy efficiency on their radar for quite some time, which is more than we can say for most commercial banks. So the due diligence processes by this time are quicker now. They have their processes set. It also has different investment criteria, and this is especially based on how ethical the project is. So I had mentioned the ESG restriction before. Like most banks, however, it requires a relatively large pipeline, but it does have a lower cost of money, which is great. Finally, I think I'll just go through one more question. I have some questions that I don't entirely have the answers to now. I have one here. Could you talk about liability management and protection from bad debt or delinquency? Have you had to exercise litigation to recover uncovered debt? I don't think we've been in the business for that long. So until now, I would say no. The liability management generally falls a lot on the ESCO, in the sense, I mean, that they have to check their, it's up to the ESCO at least to check, to have an idea of who their client is, who they're getting into bed with, essentially, who their end client is and what their track record is. Of course, you can't do a full due diligence on them yourself, and so that's generally what the investor will do. And we haven't had many bad experiences with this. but there has been one, actually, I would say, where the project was left. It was a project in Italy for a very large company. It was in the industrial sector. I'm not going to give too much information away. And in general, it was, I don't remember, it was tens of sites, industrial sites. So the projects were very, very repeatable, very easy to standardize and very safe. The returns were very good. Everything looked very good initially. And the company itself was very, very well known. So in theory, it looked great, but in doing a further credit check on the company, it turned out that actually they had not been paying their taxes for some time. So in general, in situations like this, the investor won't touch the project if the ESCO shows that they don't have good credit worthiness for any reason, or they've been doing anything in the black. It can't fly. And that's unfortunately, you get into, when you see these things, you get into realizing that there are many barriers to energy efficiency projects, one of which people don't talk about very much is poor past business practices, and which now really it will stop the finance, like full stop. So the only solution is for the end clients to change their habits. And unfortunately, that's sometimes something that you come across once you've already gotten well through the sale and the negotiation. And that's just a very sad part of the job, I would say. I think we just have time for one more short question, and then I have some more that I'll do my best to follow up with you as we go. So really short question, why can't you combine factoring with government incentives? To be honest, I don't know the technical reason, but this is, I can look it up for you. This is just the requirement of this specific investor. It's a private fund, and they generally just don't want to deal with any sort of government incentives. It's not of interest to them. And I'd love to tell you more, but I think that we're running out of time. And so I will wrap up the questions for today and finish in a timely manner. And just thank you all so much for staying on and for listening and for your questions. And I'll be sure to follow up with you all and to individually answer your questions again by email in the coming days. And please do get in touch as well if you're interested in learning more. We'd be very excited to speak and to work with you, and hope to meet you in May 29th. Thank you again to Alistair as well, and to Marion for all of your support. And this won't be the last. I think that you can expect more from us very shortly, but more on that to come. Thanks again, and enjoy the rest of your day. Bye.